The panic caused by the FOMC meeting on December 18th also sends shockwaves in the hedge fund world. According to prime brokerage flow data supplied by JP Morgan, which captures JP Morgan's hedge fund clients, that it captures the flow data for the week ending on December 18th for North American investments that involves all strategies, which is on this left-hand side over here. As we can see, the gross leverage is down 5% compared to previous week, and it's currently at 277%. And the net leverage compared to previous week has a 7.6% drop, and currently at 67%, which is represented in the blue line here. So the net leverage drop is very, very noticeable for the past week. And for the equity long-short strategy over here, the gross leverage is down 5.4% compared to previous week at 186.8%, and the net leverage is down 4%, currently at 55.8%. As we can see, there is a noticeable drop as well for the equity long-short strategy. And this chart shows you the hedge fund flow data for North American equities. The brown line represents the cumulative percentage net flow since July of 2024, and the gray line represents the S&P 500 price. Okay, and the hedge funds in North America has been net buyers since the September, which is somewhere here, right? Since September, as we can see, there is an upward trend. So they have been a net buyer for North American equity. So this data is actually in line with Goldman Sachs flow data for their prime brokerage service or hedge funds. And the Goldman Sachs data, we also share that on a consistent basis, so please don't forget to subscribe to my channel. And what JP Morgan is telling us is that last week there is a mixed net flow. There is it includes a significant sell-off, okay, because we have the short book over here. There's a significant sell-off for the last week. It's above 3 standard deviations on Wednesday. Wednesday is December 18th, which is the same day as the FOMC statement release date. Now there's a problem with this chart on the left hand side. What happened is the gray line actually covers up the brown line on this chart, and as you can see over here, the gray line covers up, but the brown line seems like it's going up. But actually, in the most recent week, there is a drop for the brown line as well. Okay, now even though there is a noticeable drop for the net flow, I personally don't think the uptrend of the net flow has been broken yet. The uptrend that started September this year, right? It's still a uptrend. It has not been broken yet. So why is the panic? Why is everybody panicking? Why is the stock market going down? Why is hedge fund panicking? It's all because of the December FOMC meeting happened on the December 18th. So in this FOMC meeting, there was a economic projection by the members of the FOMC and or the Federal Reserve, and the PCE projection has a big change compared to last time, because if you look at this chart, in the December meeting, it's red for the PCE inflation projection, okay, and each column is a year, okay, and then for September projection, which is the previous projection that was provided a couple months ago, and now as we can see, the PCE projections is going up for 2024, 2025, 2026. Okay, and that is very problematic. And this higher inflation projection into the future is causing a lot of panic. And this is the November PCE that was released this morning on December 20th. Everything seems to be a little bit cooler than expected. The overall PCE month over month is 0.1 compared to 0.2 estimated. The core PCE month over month also cooler. Year over year PCE is 0.1% cooler. Core PCE is 0.1% cooler. Everything a little bit cooler than expected, but if you look at this chart, it's the year over year. On the year over year basis shown on this chart, the green line represents the core PCE. The blue line represents the overall. As we can see, the core PCE actually on the year over year basis, it's the highest level in 7 months. Now, the reason why the higher PCE inflation projection is causing so much panic is because the institution believes that the higher valuation of the Magnificent Seven needs to be supported by a dovish Fed. Having a higher inflation may force the Fed to turn hawkish. As you can see, this chart shows you the gap between the two lines, and the blue line represents S&P 500 market cap in $1 trillion, and the light blue line represents S&P 500 X or minus Magnificent Seven, or the largest seven market cap technology stock. So S&P 500 minus those seven stocks, that market cap, and the gap, as we can see, it's getting larger and larger as the time progresses. Okay, so currently the S&P 500 market cap is about $50 trillion. Okay, and the S&P 500 X, the Magnificent Seven market cap is at $32 trillion. Okay, there's like a $20 trillion market cap differences between the two. So this is why people are so worried about the Federal Reserve breaking its high valuation. Currently, Magnificent Seven is trading at 68 times for the PE ratio. But again, as a conclusion to this video, right now it does not seem like the net flow uptrend of the hedge fund has been broken yet, based on what we are seeing right now. But so far, it does look like a beginning of some sort of a correction at the moment.